Hello traders, Gary Wagner here for Trending Markets, approximately 11:15 in Honolulu, 6:15 in New York, and it is September the 1st. It's a day we're going to remember for some time. First of all, in Honolulu, Hawaii, we had a hurricane just kind of miss us about 200 miles to the north. It is raining, but we certainly didn't get near the eye of the storm. The same cannot be said for the equities markets globally as they sell off in double, triple digit moves, dramatically lower pricing. Dow closing off almost 3% on the day, almost 500 points to the negative, 469 and change to close at 16,058. Daily chart, first of all, you can see that as this market came down, we hit this bottom. We did get a recoup, and it recouped quite dramatically up to about 16,640. Yesterday, of course, we had a mild sell-off. Today, we had a dramatic sell-off. But the real view of this market is a weekly chart, because we talked about the fact that on the last couple of sell-offs in this marketplace, we saw a characteristic, and that was that hammer-like candle that would form, and that would of course be on a weekly chart. The following week, though, you had that tremendous recovery. You had it here, you had it here, you had it here, and really what that signaled to us that the correction, these short, shallow corrections were over. Now, when we saw this same candlestick form on last week's trading activity, the notation that I made is that we might be looking at a similar scenario that we have seen. But to do that, of course, we're going to have to see follow through. Just as with the buy signal we issued in gold this morning, we waited for that confirming candle. We certainly didn't get that. You can see this. Absolutely, we have seen this market erode back down. We're about midway point from the dramatic sell-off of last week, and the sense is right now that we are still knee-deep in the throes of a correction. Realize, usually a corrective market doesn't tend to wind itself down in a matter of days or even in a matter of weeks. Many times it's a matter of months. If you look at the last dramatic sell-off, and traders, in no way do I believe we've got anything close to what we saw, of course, back in 2008. I'm trying to pull that up for us. There we go. So I don't think that we've got anything, because we don't have the same scenario that we had then. But if you consider the fact that it hit these tops at the end of 2007, it had a secondary top even into the first quarter of 2008, and that it took the remainder of not only 2008, but into the first part, I believe, around February of 2009 before it worked itself out. So we had a really hard market to deal with, but we had it for an extended period of time. Now, the other thing that we want to look at in terms of where this market is right now, and let's go ahead and blow this up, is that if we were to find some support, and quite honestly, I rather doubt it, but you've got this low here, and that's pretty much matching with the current low that we have right now. So traders, there's no doubt we were looking at the potential for a bottom. We got exactly the opposite, which is taking my strategy for looking from a buy to looking for an entry point to enter this market from the short side, because Trending Markets tries to identify extended trends. And if we break this particular price point here, and of course the recent lows even more importantly, but this price low here, and threaten this particular trading area here, traders were off to the races, because at that point we've got to start looking at different areas for potential levels of support, and they're dramatically lower than where we're at now. So we will send out a special trade alert, but as I said, we are looking to enter the market from the short side. Now, the same can be said for crude oil. Crude oil had a dramatic recovery over the last couple of trading days, in which we saw the market go from about, $38? Let's go ahead and blow this chart up, but about $38 on the low side, and then on the high side it came up to about $48. So we saw a $10 rise, dramatic rise in these 3 days. I believe it was one of the greatest recoveries in terms of the percentage gain over 3 days that we've witnessed in, I believe, 4 years in crude oil. So It's a dynamic move. However, that was all kind of taken away today as we saw this market drop and drop hard, because we saw it really trade off 10% in the same way we saw it go up 10%. But the net result is oil back below $45, and at this point, I think it could take another stab at those most recent lows, which were around $38. So crude oil is another market that we're probably going to implement from the short side in terms of what we're looking at. I think we have some tremendous opportunities that are going to become available, meaning selling crude oil, selling the S&P 500, dollar index, down pretty hard, but I imagine it would be down a little bit harder than this. But here's the thing with that. If, in fact, the Fed does not tighten or pull the trigger, as they say, for any kind of rate hikes this month now, that's going to have a dramatic effect on the dollar. Many analysts, including myself, see a rate hike as a very difficult move. On the other hand, the devil's advocate to that basic assumption is that these rate hikes are nominal at best, and it's more the level in which they rise than actually beginning to rise and see the interest rates move back up. So for that reason, I'm going to kind of stay away from the dollar. I think our best plays right now are going to be re-entering the market from the short side in crude oil and initiating a short position in the Standard & Poor's. Of course, we will send out a special trade alert to that effect as soon as these are triggered. This has been Gary Wagner for Trending Markets. We'll talk to you tomorrow. Bye-bye.